Most buyers think debt to income ratio is just math. Add up your debts, divide by your income. End of story. That misunderstanding is one of the biggest reasons loans get delayed, restructured, or denied. In this lesson, I'm going to explain how lenders actually calculate debt to income ratio, why it's not the same from lender to lender, and why this single number quietly controls how much house you can buy. Debt to income ratio, or DTI, measures how much of your monthly income is already committed to debt. It tells the lender how stretched a borrower really is. But here's the part most people don't realize. DTI is not calculated the same way your paycheck works. Let's start with income. Lenders don't simply take your salary and divide by 12. They only use income that is stable, documented, and allowed by guidelines. W-2 income is usually straightforward, but commission income, bonuses, overtime, and self-employed income are not. Those types of income are typically averaged over time, sometimes over 2 years, sometimes longer. If income is declining, lenders often use the lower number. If income can't be properly documented, it may not be usable at all. That's why two borrowers earning the same amount on paper can end up with very different qualifying incomes. Now let's look at the debt side. Lenders count monthly obligations that appear on the credit report or are required to be disclosed. Car loans, student loans, credit cards, personal loans, installment debts. But again, not all debts are treated the same. Credit cards are usually calculated using the minimum payment, not the balance. Installment loans may be excluded if there are only a few payments remaining. Student loans can be calculated multiple ways depending on the program and documentation. Deferred loans may still count even when no payment is due. Then there's housing. Your housing payment isn't just principal and interest. It includes taxes, insurance, HOA dues if applicable. This is where buyers get caught off guard. They qualify for the price, but not the payment. Now let me give you a real world example. Two borrowers make the same income, same credit score, same purchase price. One has a car payment, student loans, and multiple credit cards. The other has fewer obligations. On paper, they look identical. In underwriting, they are not. One qualifies comfortably. The other is right on the edge or over it. Here's another example. A borrower decides to pay off a loan to improve DTI. That can help or it can hurt. If paying off debt drains assets or reserves, it can create a new problem. In some cases, paying off a small installment loan dramatically improves DTI. In others, it weakens the file. This is why strategy matters. DTI is not just a number, it's a lever. Now let's talk about limits. Different loan programs allow different maximum DT is. Conventional loans are typically tighter. FHA often allows higher ratios. VA focuses more on residual income. Jumbo loans vary widely by lender. That's why one lender can say no, while another says yes without anything changing. Here's how lenders actually think about DTI. They don't look at it alone. They look at it in context. Strong credit, stable income, solid reserves. Those things can support a higher DTI. Weak credit, thin assets, inconsistent income. Those tighten the tolerance. DTI is one layer of risk, not the whole story. To wrap this up, understand this. Debt to income ratio quietly controls loan approval. It determines flexibility. It determines options. It determines how much margin for error you really have. When you understand how it's calculated and how it can be managed, you stop being surprised in underwriting. You stop reacting late and you start structuring the loan correctly from the beginning. If you want to go deeper or you want your own numbers looked at correctly, connect with me directly. My name's Ricky. My friends and clients call me Rick. I'll make sure you understand how your loan actually works before anything moves forward.